Hello everyone, welcome to my channel. Why I did not get $195,000 for life. You should watch this video before buying whole life insurance, and here's the reason why. This is $195,000 death benefit paid to you if you buy a whole life insurance. So before I talk more about whole life insurance, we need to understand what is the difference between term life insurance and whole life insurance. When you are searching to get a better life insurance, so you actually need to understand this term first. Whole life insurance is a permanent insurance policy guaranteed to remain in force for the life of the insurer or the buyer as long as the premium are paid. This is important. You have to pay the premium, then you will be guaranteed a death benefit. There are pros and cons from having whole life insurance. Each individual person have a different lifestyle and needs. Your needs may not be the same like my needs. I think whole life insurance policy is so complicated that an average person like me does not understand the concept. And for me, I need to actually do more research and learn about whole life insurance policy before signing any contract or document. When you don't do your research on whole life insurance that you're about to buy or sign, you will regret in the future. There are many terms in the policy I don't understand personally after I read the document, and I need more time, and as well as you do too, you might need time to understand them. And there are pros and cons on buying whole life insurance, not buying term life insurance. A lot of people prefer whole life insurance because of the benefit of whole life insurance different from the term life insurance. Whole life insurance can build cash value, and also it's a cover for whole life until you die. The benefit you will get is prior to death, and also it can act like investment account. The cost that you have to pay for the whole life insurance is fixed, and it continues to protect till you die. And also whole life insurance ensure that your burial costs and other final expense are covered. Whole life insurance also can be a benefit transfer to the beneficiary tax-free. Term life insurance is only cover fixed period of time that you buy. You can buy 10 year, 20 year, and you pay towards the term life insurance. When the year is done, then you can continue to purchase more, or you can convert it to a permanent life insurance. Term life insurance does not provide any investment option, and it also is term life insurance cost fixed or for the contract time, which means if you have a 10-year fixed contract to pay every month $35, then that will be your fixed cost. Let's dive into a life insurance certificate illustration for a mega plan, $195,000. Before we do that, let's just look at the term that the life insurance, whole life insurance contains. So we have attained age. Attained age is insurer age at the beginning of the certificate year for the term insurance premium calculated, and the end of the certificate year for permanent insurance cash value and dividend earning. Then we have guarantee maximum premium, meaning guarantee may be required to keep the certificate in force. Included in this premium is the base premium and any rider premium until their expiry date. The premium is represent on annualized amount. Then we have guarantee cash value. Guarantee cash value means guarantee amount payable to the owner if the certificate is surrendered at the end of the year shown. And then we have guarantee death benefit. Guarantee amount payable to the beneficiary at the insured death in the year indicated. The amount payable at death will never be less than this amount unless there is an unpaid loan. So if you have that benefit for, let's say, $100,000, and you borrow it from this that benefit $25,000. Now, upon your death, then the insurance company will pay you to your beneficiary $75,000. Okay. Contract premium. Contract premium means premium payable to keep the certificate in force. So you have to pay the premium for the certificate, which is the policy, to be in force. Because if you don't pay, that means now you are voiding your contract. Included in this premium is the base premium and any rider premium until the expiring date. the loading for the premium payable for any basis other than annual are not included in this amount. This is a non-guarantee element for a life insurance certificate. So you have to have a rider, which means after you buy the base premium, now you want to buy the rider to coverage to get to be earning more cash value. Annual dividend, amount of return premium based on PRCUA. PRCUA stands for Polish, let me look, Polish Roman Catholic Union of America. So this is the whole life insurance that offered by Polish Roman Catholic Union of America. And you can go to the website and search and look more about them. And this is good to learn more about whole life insurance if you are interested in this. Total cash value. Sum of the guaranteed cash value and any accumulated dividend, this amount is payable to the owner if the certificate is surrendered at the end of the year shown. If premium payment are discontinued, this amount can also be used to purchase a fully paid-up insurance certificate with an initial insurance benefit less than the initial insurance benefit shown above. It can also be used to purchase an initial insurance benefit greater than or equal to the initial insurance benefit shown above. But its term is limited to future period of time, extended insurance. And also this is not a guarantee element in the life insurance itself. And total death benefit is a sum guaranteed death benefit and the accumulated dividend. Accumulated dividend, which means you probably have a rider, which means you buy on top of the base premium, you buy another coverage. So this one accumulated dividend that you're earning will be added to your death benefit. This amount is payable to a beneficiary at the insured death in the year indicated. This is a non-guarantee element for a life insurance certificate. So that is all the term. I mean, not all of them, but I did cover some of them based on reading from the script itself. Now let's look at the illustration of this life insurance certification. For $195,000, this is the female person at age 37 trying to buy a whole life insurance, and the premium she requested for $195,000, she will have to pay the premium $122 every month. Okay, the initial insurance benefit is $125 for whole life. Okay, this is a risk class is pre-NT WL whole life. And as you can see here, 37 years old, 5 years later, in 5 years at age 42, the maximum premium every year is $1,470 for 5 years. With the cash value for the premium that the person put it in is only $3,000, but the death benefit is $195,000. Now, if the person buy a rider, right, to cover into this policy, whole life insurance policy, then they can earn more. They can earn up to $3,850 cash value, so almost $700 different. Okay, then their death benefit is going up. This one is $195,000 with the basis premium, and with the rider premium, you will actually have increased your death benefit to $195,759. Okay, $195,759. So this is when you purchase more coverage as a rider. Okay, the PUA is a pay up additional insurance rider. If you have a two identical whole life insurance policy and have the same annual premium, but one have a pay up rider and the other one doesn't have it, the one with the rider will have a higher guarantee net cash value sooner than the one without it. So this is the comparison. One, it doesn't have a rider. This one have the rider. So the rider will build up more cash value because of the dividend that they receive. Okay. However, a policy that allows for pay up additional may initially have a lower cash value because most of your premium that you're paying towards the whole life insurance from 1 to 20 years, 80% of it gonna go into the agent. So that is their commission. So you pay into their commission for the first 1 year to 20 years. This is why your cash value build up so low. And after 20 years, you will start earning those, increasing your cash value. If you do a calculation, if you pay to the premium every month, $122 a month, for 1 year you will have $1,470. But right here, your cash value only $3,000. If you do a calculation, if you pay $1,470 every year times 5 years, you should have the cash value is $7,000, $7,350. But instead, you only have $3,000 cash value. So almost 80% of your money that you put in will pay into the agent commission. And the same thing with 10 years. If you put $1,470 every year into your whole life insurance, for 10 years, you will actually should receive $14,000, but your cash value only $9,800. So other money will go into the agent commission. It takes you 20 years to accumulate almost 80% of your money. Now, the premium you pay into which is decreasing. So this is why it's so important for you to look at it first before you buy any whole life insurance. The first 1 to 20 years, most of your money will pay into the commission to the agent who have signed you the contract. And remember, when you have a contract signing with any agent, make sure you understand that if you do a pay up additional insurance rider, you must be structured into the policy when you purchase it. If you don't, if you want to buy it later, you might not be able to do it. You might have to buy a different separate policy, a whole life insurance policy, a separate one. Because some whole life insurance will not allow you to add any additional rider at later. Okay, or maybe it even cost you higher at, if you buy it later in your term, in your whole life insurance. So if you do want to buy a rider, you have to buy it at the beginning of the contract that you're signing. And as you can see also, a non-guarantee, it's just almost the same thing. If you buy a rider, then you pay, the annual pay up additional coverage is $200. That means you pay premium here, and then another contract premium added, then you pay additional $200. But then you will earn the dividend interest on it and add it to your cash value and also add it to your death benefit. Now I'm going to go show you. So this is the summary of it. Now it also have a non-guarantee intermediate. Remember the definition of a non-guarantee and intermediate is dividend at 50% of the projected value, and also is a non-guarantee. This is a little bit different right here, non-guarantee. So they pay similar, but you buy it only $100 towards the premium, the base premium, and then they will earn whatever you have right here, $195,000, but additional $380. So your death benefit will be increasing to $195,380. Now this is done. You sign right here. I have received a copy of all pages and this illustration. I understand that any non-guarantee element illustrated are subject to change and could be either higher or lower. So based on the investment for you, it could be higher and lower. And you might not be able to select the investment itself. They will select it for you. That's why they earn the commission. They can put your money into an annuity. They can put your money into a mutual fund. So they do it for you. And then they will tell you, okay, they interview you first. The agent came to your house, or you can set any place, not in your house, but somewhere else if you want to. Then they will explain it to you, all of these that I mentioned. They will explain most is using this table and explain it to you what the cash value work and how you can actually borrow from your policy, and then with the interest, when you borrow it, they have an interest on it and you have to pay it back. If you don't pay it back, then your death benefit will be decreasing. And when you understand everything, you sign. But sometimes you don't need to sign right away. You need to think and evaluate, is this the right policy for you, or is this the right place for you to put the money in? Okay, there's a lot of investment vehicle out there. You don't need whole life insurance to make your money grow. You don't need whole life insurance to have the death benefit $195,000 for So this one is 30 year, I believe. 30 year. Yep, 30 year. You don't need that. You actually can earn money by using it investing into something else. So this is how to explain it every year. Like how your money will be put in there and where the money gonna be. For example, at age 37 to 38, you are paying the premium $1,513. Your death benefit is $195,000. You don't have any cash value, okay? So the money will go directly to the commission. From year 2, in year 2, the same thing, all the whole premium you're paying to the commission and fee. Now year 3, you actually earn some money. You earn less than, let's see, how many percent was paying towards you. You build the cash value on year 3, $670 cash value on year 3, and this only 45%. 55% we're paying to the agent commission, okay, because they're the broker. Now they are paying for what they earn from it, which means they try to set up your account and they make the investment for your account, everything else. So all the money will have to pay to them first. Now year 4, what you now have some cash value, and also your death benefit is $195,000, always guaranteed. Remember, even though you don't have cash value on year 1, year 2, and year 3, but you guarantee death benefit. So if you somehow hit by a truck, forgot, like hit by a truck and then you somehow die, now you don't have cash value, but you will be guaranteed get paid to your beneficiary. If you pick family member, then your family member will earn $195,000, from this life insurance, and it's tax-free. Okay. Then year 5, you actually earn more cash value. Now, when you have cash value, now you can borrow from it. Okay. You say you have year 3, $670. Now you can borrow this cash value. You can borrow all of them. On some policy, in whole life insurance, you can borrow up to 80%, and sometimes you cannot borrow all of them. You can borrow only 50%. It's up to the policy that build it into this whole life insurance that you buy. And then when you borrow it, then you have to pay it back. When you borrow it, and it will say, okay, 4% interest rate, then you have to pay the original amount and plus the 4% interest rate on that money that you borrow back to your whole life insurance policy. Okay, so it's continue on until 10 year, and then your base premium continue to pay and then decreasing, but your death benefit is remain the same. But if you buy the rider contract, then it's growing. So make sure you do that if you decide to get a whole life insurance. If you don't, you can invest into any investment account and try to do your own investment. Now right here, from year 11 on, you continue to build up cash value. Okay, you have earning more to touch the cash value. And now you go into 30 year, you even earn more cash value. You have built up your cash value, you can borrow it. But if you look at the rider, you earn even more, $60,000. Okay, so that's it. I hope you see this video is very enjoyable, and then explain a little bit on whole life insurance and what it look like if you buy a whole life insurance. So make sure, try not to buy whole life insurance, and if you don't understand them, that means they did not explain it to you very well, and you don't have to buy them. You just have to say thank you and then let them go. They will try to come to you, they will try to offer you the whole life insurance and then try to convince you to buy it. Okay, they might come to you, they waste their gas, everything else, but hey, this is the product. You look at the product, you don't like it, you don't understand about it, and it's too complicated to understand, do not buy it. I did not buy any life insurance. I did not buy whole life insurance, basically, because when I look at it, I actually can use the money to invest using my own investment, vehicle, and buying my own mutual fund without have to pay any extra fee. 80% or 75% for the last 20 years before my money grow. My money start to build the dividend and to grow at the year 1. Now I don't have to wait for 20 years to to build all those money. But of course, I don't have the guaranteed death benefit $195,000 towards the investment that I'm going to be put it in, because there's always up and down and high risk and low risk based on my investment. Thank you so much for watching. Please subscribe to my channel. Have a good day.